Hey, this is Michael Milteer with Trisha and Midgett's team here on the Outer Banks. Today we're shining a local spotlight on one of our local lenders, Alex Wright. Alex, can you tell us a little bit about yourself and how you got involved in the banking industry?
Yeah, so I'm originally from the Outer Banks, and I've been in banking since 2017, so about 7 years. It was kind of a natural progression because my brother is a certified financial planner at Northwestern Mutual, and I kind of was following in his footsteps in the financial space. And also my dad is a mortgage lender as well. So it's just a natural progression for me to be in mortgage financing, and I've really enjoyed working with my dad over the past few years.
So what made you decide on First National Bank?
Well, there was a lot of different choices of banks that I could work for, and I wanted to work at a bank that was really engrossed in the community. And that's what First National Bank is. We have 7 different branches from Southern Shores, Nags Head, Manio, Avon, Hatteras, and even in Ocracoke. So I really feel like we're here to serve the community, and we also specialize in second home and investment financing.
Alex, we know your company has some great products to offer for the local community. Could you tell us a little bit more about those?
So for the community, we're able to offer a lot loan program. It's really a great way or a great tool for a person to achieve home ownership. And basically we allow the borrower to secure the land for their home site in advance before they get their construction loan.
That's incredible, and I actually have done their construction loan program, which is an awesome tool to use as well. Could you tell us a little bit more about that?
So yeah, the construction loan's a great option for people building a house, and basically we try to simplify that process as much as possible for the borrower, where they're able to get one loan, where that one loan pays the builder and gives the client or the borrower a permanent mortgage. It's common that for other banks to do a 2 closing process. And so overall, ours is a much simpler process because they're only going through the mortgage process one time, hence the name, the one-time closed construction loan program. And so when it comes to cost as well, because they're not closing twice on 2 different transactions, it's gonna lower their cost substantially doing the financing with our program.
Another big market we have here on the Outer Banks is going to be for our second home owners and how they go about buying a property down here. Could you give us a little in-depth on that?
Yeah, for the second homeowners, they are typically very down payment sensitive. And so when choosing First National Bank, I wanted to make sure I could offer programs that would have 10 and 15% down options. And so that's what we're able to offer here with our adjustable rate mortgages, our ARM products.
And for some of our viewers that might not know, what is an ARM product?
So the ARM product is basically a term where the rate is locked for 5, 7, or 10 years. And basically during that time period, we're anticipating the borrower is going to refinance their house, or they're going to sell their home or pay off the mortgage. And more commonly, the goal right now is to basically date the rate for a short period of time where they purchase the house and then a few years later they're going to refinance it. I think a way that First National Bank stands out compared to some other lenders is that we actually offer a 15-year ARM product. And so if you really want to pay off your mortgage quickly and you're also getting rental income from renting the property seasonally, it's a great way to potentially pay off the mortgage within 15 years if you can already make a mortgage payment yourself and the renter's basically making the payment. It's a great way to achieve home ownership with very little debt and very little risk and still get a program that offers 10 or 15% down.
And you briefly mentioned rental income. Could you tell some of our audience how that helps with investors, how the rental income can actually maybe help offset the cost of ownership?
So for investors, it's super common that they may own 3, 4, maybe as many as 7 or 8 different rental properties. And the rental income is super important in those scenarios because they need that rental income to qualify for that new mortgage payment. And so how we're able to do that from a banking compliance standpoint is we have a third party, being the appraiser, that does what's called an income and operating statement, or a 1007 as an industry term. And basically the appraiser gives an estimated number of what the rental income is for that property. And so underwriting or the bank will use that income figure that the appraiser gives when it comes to qualifying an investor. And from an investment standpoint, this just allows borrowers to achieve another home that they may have not been able to own if they didn't know the ins and outs of how to use that potential income and where to get a third party to identify how much that rental income is.
Yeah, that's incredible. And with some of our owners that have 7, 8, maybe even 9 homes, is there a limit to how many rental homes they can have when they go to qualify for one of these?
Yeah, so that's a really good question. It can vary a little bit, but for most borrowers in these situations where they're buying properties that are really under a sales price of $957,000, if you're under that sales price, you're basically, no matter whether you classify the property as vacation and second home or investment home, you can have up to 10 mortgages. So we give, in my opinion, a lot of flexibility. Now, if you're in the higher sales price space of, basically $1 million and higher, for those vacationers that just are buying their first initial second home, again, that rule is you can own up to 10 properties. So it's just when you go to the multi-million-dollar properties, third or fourth property, for them to have 6 or 7 mortgages is going to be more restrictive.
Buyers in our area have tons of questions before purchasing a beach home. One of their biggest is, what credit score do they need to actually purchase a beach house or a second home?
So for credit scores for second home buyers, it can be a little scenario dependent, but most of the time we need over 650 credit for them to qualify for a second home or investment property.
And if their credit score is below 650, is there ways that they can increase their credit score?
Yeah, if they get to us far enough in advance, it's of course always a good idea to talk to a lender as far in advance as you can. And for those situations, we basically want to help borrowers or clients build credit over time. And a good way to do that is to add additional secured trade lines, such as credit cards, or if you're going to, for example, purchase a car in the future, that would be a way to build credit over time. And typically, credit is built over time through 6 months or a year. So if you secured a credit card, or bought a car, or secured a credit card for only a month or two, it's really not long enough. You really need to own or use that credit card and show that you're able to make a payment and pay back that debt that you owe for 6 months to a year to really build credit over time, which really is why I want clients or borrowers to get to us as early as possible, especially if they have credit questions or issues.
Another question people have is, what can your debt to income be to actually purchase one of these homes?
Yeah, so most of the time for people that have high credit, that's credit typically over 700, their debt to income ratios can be up to 50%. And so an easy way to think about that for borrowers, if someone makes $10,000 a month or $120,000 a year, the $10,000 a month, 50% of that number is $5,000. So all cumulative payments, including their new mortgage and their current mortgage or car payment, for example, cannot exceed $5,000. So it's an easy way to explain to clients that your debt to income ratio can't be over 50%, and it's really a calculation of your existing and new mortgage payment versus your monthly income as a borrower.
For our investor clients out there, I know a lot of them say they have a ton of hard assets, but maybe not as much liquid cash. Is that something you guys can help us with?
Yeah, definitely. So First National Bank really specializes in some of the cash out products that are really the most favorable for clients or borrowers. And one of the most common ones that we hear about for cash out of getting that hard asset where you might have a lot of equity in the property, but you need to get cash to purchase another property as an investment, is using a home equity line of credit. That's the more common way where people borrow money. And the great thing about home equity lines of credit is that you can pull that money whenever you choose to. So a lot of times borrowers basically identify or close on a home equity line of credit, make zero payment or pay zero interest, and then when they find an investment property, then they pull the money and use that money for a down payment to buy another investment property. That is what's great about a home equity line of credit product. Our home equity line of credit product at FNB, as far as rate, I think super attractive. It's 7.5%, as long as you have high credit and the equity that we're looking for. Another product that we have that's super similar, but a lower rate that not a lot of other lenders are going to offer, is we offer a home equity loan product. And that's a fixed term period. That means fixed term being it's a 15-year loan. So you get almost a point lower than the home equity line, which for investors is a great way to say, look, you're going to pay a lot lower or a lot less interest than you would if you use the home equity line of credit. And it's a way for us to differentiate ourselves. So we can use hard assets in a way to get the money out of a primary home, especially, is the best way to do it. Using that hard asset to get the equity out of that property or the cash. And then I think the last point I want to make here, Michael, is important for our borrowers or clients, is that we need to identify where the cash is coming for a down payment really early on in advance. A lot of borrowers don't have the cash liquid yet for like the investors we just talked about. They could be getting a gift from a parent or a family member, or they could be selling a different item and not have the cash in the bank. And lenders want to identify and use funds that are secured or sourced. And so it's another conversation, kind of like credit score. The earlier you tell me about it in advance, the more we can be proactive and create a plan or a strategy for you to successfully buy the home in the best way possible.
When we talk about loan products, we always hear about first-time home buyer loans. Is this generally a good product for the buyers?
It's really another case of scenario dependent, Michael. For lower credit scores, the first-time home buyer product is a really great product. But like a lot of things or solicitations that you see, they're just always not quite what they're cracked up to be. And for the first-time home buyer program, FHA, there is a funding fee, and that funding fee depends on the loan amount, and there's scenarios where it varies. But basically, if I can remove that fee for borrowers, then for a first-time home buyer program, I can do that with someone who has really a credit score of over 690. And so I'm always trying to look for ways to have a client have lower closing costs or lower fees. And so if a client has above 690 credit and we're looking to buy, a first-time home buyer type of situation, then we can do 3% down, we can avoid the fee, and we can get really an attractive rate still when you have a 690 credit score. So the program does have its place for lower credit scores, but like I said, if you get to us early and we can kind of get your credit higher by some of the strategies I mentioned, we can avoid having that fee in the FHA program.
So when we finally get the buyer under contract on their dream home, what are some things we should tell them not to do?
Yeah, this question comes up a decent amount. And basically, we do not want a borrower to go get another debt or another payment. For the common ones, we don't want a borrower to get another car payment. That I feel like has happened before or had that question. Another one that might be a little bit smaller of a ask is that we don't want them to get a new credit card or be checking their credit with other agencies, because every time they check their credit, they're going to have to provide an explanation. And our hope is that you don't have a new payment, because if you do have a new payment, it's more documentation. And we want to make this as timeless and simplified as possible for the borrower. And therefore, if you don't pull your credit with other credit agencies, it's going to make it a lot simpler.
A lot of times when buyers finally want to go make the offer on their property, they always wonder, how is getting their credit score pulled going to hurt their credit?
Yeah, so when it comes to the borrower's credit scores, there's 3 different agencies that give a borrower their credit score. There's Equifax, there's TransUnion, and there's Experian. And we're going to take a middle score from those 3 different credit agencies. And when a borrower has a hard pull on their credit from a lender, typically the effect on those agencies is maybe 5 or 10 points. It's not a substantial amount. It is, of course, scenario dependent. There may be no effect, but it wouldn't be a reason, in my opinion, not to set yourself up for success to buy a property, whether it's a second home or vacation home, because you're afraid to get your credit pulled. Again, it's 3 different agencies, Experian, Equifax, and TransUnion, and typically your score isn't affected more than 5 or so points.
Is there a timeline for when they might be able to gain those 5 or 10 points back? Is it 5 months, 3 months, something like that?
To confidently say that their credit score to regain that 5 or so points would probably be about 6 months. But typically a borrower might check their credit with my bank, maybe a competitor bank. And in those situations where you had credit pulled one day and then the next day, just to shop mortgage options is not going to affect your score when it's pulled within a certain 7 to 10 day time frame. But it's when you pull your credit every 30 or 60 or 90 days that you would have a significant decrease due to over time consistent credit pulls. So you want to minimize credit pulling as much as you can, because of course you don't want your score to go down. But again, I don't think it's a reason not to pursue knowing how you qualify and how to get the best terms on a mortgage.
No, that's definitely some great information for us. Alex, thank you so much for coming on today. Is there a way for our viewers to get in contact with you if they have any questions about the pre-qualification process?
Well, Michael, thanks for having me. And the best way to reach me is by phone. Just give me a call. It's 252-256-1050. And I also write a weekly newsletter and include what the market is doing rate-wise. And we're gonna have those links below on how to best get in touch with me and be on the newsletter.
Awesome, man. Well, thank you so much for coming on. It's a pleasure having you.
Yeah, I've enjoyed it.